getting to a place where the demands for physical are starting to overtax the inventories on metals exchanges. And that's kind of what people mean when they talk about a short squeeze, where the people who are short now have to come up with silver, and there is no silver, or there's not enough silver. And so let's say an exchange has a technical default because they don't have the silver, so they pay you in cash. It's not that your contract expires worthless, but you can't get the metal for it. You have to accept the cash for it. And that will be seen as a default on the part of the exchange.
It's one thing to have a market built on speculation. It's another when that speculation threatens to break the system itself. That's what's now unfolding in silver. John Rubino explains that for decades, the silver market has been quietly manipulated through futures contracts, paper promises that rarely result in anyone taking home actual metal. Futures were designed as tools for hedging and price discovery, but over time, they've turned into a leveraged casino where traders bet on silver's price without ever touching an ounce of it. On paper, this setup works, until people start asking for the real thing. Rubino says that's exactly what's happening now. COMEX and other exchanges operate like fractional reserve banks, holding only a fraction of the silver they've sold claims to. For years, hardly anyone demanded delivery, so the imbalance went unnoticed. But as more traders request physical metal, inventories are running dangerously low. If too many holders demand silver at once, the exchange will be forced to settle in cash, a technical default that would instantly expose how little real silver is backing the mountain of paper contracts. At that point, Rubino says, the industrial world would panic. Companies that depend on silver, from defense contractors to solar manufacturers, would scramble to secure supply at any cost. Prices would spike violently as physical silver vanishes from the open market. What used to be a quiet, paper-based game could quickly turn into a historic short squeeze, one driven not by speculation, but by survival. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
Oh yeah, people have been manipulating the silver market for decades in futures contracts. And a futures contract is normally settled in cash. It's just it's a bet that you place and then you take off and everything. So it's basically just a casino, futures markets. But a futures contract, a long futures contract, does give you the right to call for delivery on the commodity that you're playing with. And very few people used to do that, but now more and more are starting to do that, where they say, okay, I've got this futures contract, but I don't want cash for it. I want the silver. And exchanges like the COMEX, for instance, are highly leveraged. You know, it's a fractional reserve banking system, in effect, where there are a lot more futures contracts out there than there is physical silver sitting in vaults to satisfy those futures contracts. So we're getting to a place where the demands for physical are starting to overtax the inventories on metals exchanges. And that's kind of what people mean when they talk about a short squeeze, where the people who are short now have to come up with silver, and there is no silver, or there's not enough silver. And so let's say an exchange has a technical default because they don't have the silver, so they pay you in cash. It's not that your contract expires worthless, but you can't get the metal for it. You have to accept the cash for it. And that will be seen as a default on the part of the exchange. And that'll spook everybody, you know, because they will then realize that there's not enough silver to cover the claims against it. And if you're somebody like, if you're Raytheon, you're making missiles and there's silver in those missiles, or if you are a solar panel maker and there's silver in the solar panels, you got to stock up in the face of that, right? So you have no choice. You can't just shut down your assembly line. You have to pay whatever it takes to get the silver to make sure you can handle this year's orders. And so that's where the rubber really meets the road, is when, there's not enough silver on an exchange to satisfy futures contracts out there, and then everybody panics and they want it in the spot market, not even on a futures exchange, and they just want to buy whatever they need, and price becomes less relevant because the difference between paying too much for a component of your solar panel and then making a little less profit next year, and on one hand, and on the other hand, having to shut down the whole assembly line and making no profits and just going out of business. The choice is obvious. You pay whatever you have to pay to get your silver. And we're kind of headed for a time like that, where the exchanges are overtaxed. People are watching this process and thinking, all right, I think I need to preempt this by getting some silver right now. And so that's why people are cashing out their futures contracts for physical. And that's probably why a lot of buying is going on out there off the exchanges, but involving, physical silver from one vault moved into a manufacturer's vault. And there's not that much silver. And so what does that mean for silver prices? Well, we've seen some things go straight through the roof during buying panics lately. Bitcoin just went crazy in the last few years, and Nvidia stock it went up by not 100%, but thousands of percentage points. And there's no reason why silver couldn't see something like that going forward if it becomes the object of panic buying. So there's just an awful lot of cash out there. And should some of it be redirected into the silver market, then, it's hard to know what the upper price range would be. And I could throw out a lot of guesses, but they would just be guesses. But they would involve triple-digit silver, at the peak of the cycle. And I think we could be seeing that in the not-too-distant future if the whole, default on an exchange thing happens or seems imminent.
The cracks in the financial system are no longer theoretical, they're visible. John Rubino says the recent loss of control over interest rates is a clear warning. If yields were falling, it would suggest central banks and governments still had tools left to manage the chaos. But with deficits exploding and rates staying high, it's clear the system is starting to unravel under its own weight. For those who began accumulating gold and silver years ago, this shift is validation. They've preserved and grown wealth while most people stayed parked in paper assets that are now losing real value. Rubino says as inflation eats into savings and trust in currencies erodes, these early adopters will hold the kind of capital that matters when the monetary reset finally comes. The majority, however, are only now waking up. Many still think gold and silver are old-fashioned, but that narrative is fading fast. Even at record nominal prices, Rubino argues we're not near the end, because governments are still printing, borrowing, and debasing. Until that stops, precious metals will keep climbing. He says this isn't another temporary bull run. It's the early phase of a major revaluation, one that will redefine what real money means. Let's get back to the interview.
What we're seeing in the world right now is instead of governments getting their act together, the exact opposite. Deficits are going up rather than down. The amount of debt that's accumulating is increasing because of the deficits and because of the interest cost on the existing debt. But interest rates aren't going down. One thing that it would be good for gold and silver, but it would be a sign that we're at least stopping the accumulation of debt would be for interest rates to fall dramatically from here, because that would imply that governments are still in control of the financial markets because they want lower interest rates. But if they're not succeeding in getting them, that tells us that instead of becoming more and more under the control of wise governments, the financial markets are spinning further and further out of control. The bond market is just not listening to central banks now, or else we'd have a lot lower 10-year yields on all the big government bonds. And that's not the case. So, it would have been much better to buy your gold and silver 10 years ago, or just start buying it in, say 2015 or so, and then just continue to stack up until the current moment. And a lot of your customers, a lot of my subscribers have done that. And they're part of the new generation of rich people coming along who are going to have the capital to rebuild the world when when these currencies collapse. But the majority of people are just now kind of waking up to the idea that gold and silver might be good investments, and so they're looking at it and going, well, like you said, it's at an all-time high. Just on principle, I don't buy things when they've hit an all-time high. But in this case, there's no reason for the current price to be the all-time high permanently, because governments are not slowing down the debasement of their currency. They're actually increasing that in most cases. So, until that changes, gold and silver have a wind at their back and probably an upward trajectory in price. Metals miners and the royalty companies that are kind of sort of somewhere between a metals bank and a metals miner are leveraged ways to participate in precious metals. In other words, you can buy physical and it will go up if the value of what you own will go up if the price of gold or silver goes up. But some of the miners, if they do well, are leveraged because their value goes up according to how much they've got in the ground. And if they've got a lot of gold and silver in the ground, then their stock tends to move in an exaggerated way relative to the metal. So a well-chosen miner is a way of building capital, whereas physical gold and silver are good ways to preserve capital. So if you want to just make sure you have the same buying power 10 years from now as you do right now, gold and silver bullion would be a thing to own. If you want to quintuple your capital, then the mining stocks, or at least the best mining stocks, are ways that can happen pretty easily in a precious metals bull market. We've seen that, on my Substack portfolio that I publish for subscribers. There's a thing called the 100% Club that is growing like crazy. That's the stocks in the portfolio that have at least doubled. And I'm going to start tracking the 200% and 300% clubs pretty soon too, because a lot of these things are just taking off. They're going up some multiple of what gold and silver are going up. And that's how it works in bull markets. And this might be the mother of all precious metals bull markets. And if that's the case, then the miners are going to look just great. And by the way, we are just entering a new earnings season. A lot of companies that are on standard quarterly reporting periods are going to start reporting here pretty soon for the third quarter, and the miners are going to put up phenomenal numbers in the aggregate. Some of them are going to just make a ton of money, or they're going to report making a lot of money in the third quarter. And that's going to make them look very interesting to generalist investors who don't necessarily care about mining, but they do care about momentum. In other words, if your earnings are rising at an accelerating rate, they show up on these generalist money manager screens. And if the stock price is going up along with earnings, that shows up in other screens. And so you're going to see some money or more money pouring in from outside from people who just love the momentum. They're playing the trend rather than actually trying to understand the dynamics and the fundamentals of these miners. And that will just make the miners go up that much more. So again, standard bull market dynamic, but this is not a standard bull market. So it could be a lot more extreme than what we're used to.
There's a quiet unease spreading through the financial world, and silver happens to be at the center of it. What used to be a stable, predictable market has turned into a pressure cooker of unmet promises and dwindling supply. Beneath the surface, exchanges that once seemed bulletproof are being tested by something simple but unstoppable: people asking for what they're owed. The moment those paper contracts meet the hard limit of real metal, theory gives way to reality. That's when confidence cracks, and markets stop behaving like numbers on a screen and start acting like survival games. Industrial users can't pause production, and investors can't print silver. When scarcity becomes visible, price becomes irrelevant. What's unfolding isn't just a commodity story, it's a stress test for the modern financial system, where the distance between perception and reality is vanishing fast. As that gap closes, the real question becomes: how many markets built on promises instead of substance will survive once people start demanding the tangible over the theoretical? So stay tuned. If you're into real, data-backed takes on the financial system, Hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.